Welcome, everybody. We're here with my good friend Nathan Davis from Community Lending. We're here to talk a little bit about what I was going to talk about last week, which was this new mortgage thing that was going on that was going to dock the folks who have great credit and somehow give that discount to the folks who have bad credit. And I was going to talk about it until I gave my friend Nathan a call to say, tell me what was really going on. And Nathan said, stop, don't say a word, and let me tell you exactly what's happening. Nathan, tell us what's really going on in the marketplace.
Well, first of all, has your blood pressure come down since we had that conversation?
I was pretty upset at that time.
You were pretty riled up.
I had many customers come to me immediately going, Phil, what the heck is this? They're going to raise my mortgage rate and then give that to people that can't get qualified and lower their rate with my money? What kind of BS is that?
Yeah, that would be crazy.
I couldn't believe it either, but nothing puts me over the top more than doing a Robin Hood thing,
Right.
with this administration. So is that what's really going on?
Not at all. And we don't want anybody to go tank their credit to think that they're going to get better mortgage rates.
Well, that's what I was hearing. I mean, I told Jennifer, I said, I think I have to stop paying my bills.
Right. No, keep paying your bills.
Okay.
Yeah, no, we're gonna bring out the truth in this whole thing. But to really kind of understand what's going on, I'm going to kind of bring you back to how are mortgage rates really set in our industry. And conventional lending, which is most of the customers that we're dealing with, they're doing conventional loans. About 80% of the loans that are underwritten, closed, Fannie Mae or Freddie Mac own that paper. Okay, so basically whether I originated, Wells Fargo, Chase, Bank of America, et cetera, when they're underwriting the loan, they're underwriting to Fannie Mae, Freddie Mac guidelines. They govern conventional lending, and they're the ones that really, set the interest rates for most of us who are originating loans. Now, the way they do that is basically they are, they're publicly traded companies. They want to make money, and they, set these based on mortgage-backed securities, trading mortgage-backed securities. So mortgage-backed securities, they trade much like a treasury bond would. And they go up and down depending on what the market's doing, who's buying, who's selling, et cetera, et cetera. And depending on how that works, that's how rates go up and go down each and every day. Right. And then Fannie Mae and Freddie Mac, based on how mortgage-backed securities are traded, say, okay, lenders, here's what your rates are, throughout that particular day, week, year, et cetera. So that's obviously where we get our interest rates from, or what Fannie Mae and Freddie Mac's willing to pay for a new mortgage loan. Now, the thing that most people haven't really realized is, well, okay, why are rates different for somebody with a low credit score versus somebody who has a high credit score, somebody who puts 50% down versus somebody who puts 3% down? How is that adjusted? Well, it's called loan level price adjustments. Loan level price adjustments have been around since I've been in the business. They adjust, every so often based on, again, how Fannie Mae and Freddie Mac evaluate risk. They're in this business to make money, right? So they, usually annually, sometimes every couple of years, make adjustments based on what are they seeing the market do. So these loan level price adjustments basically adjust for risk, okay? So if you think about it, maybe to make it easy for the audience, you're from the New York area, right?
Brooklyn.
All right, Brooklyn. So you walk into your favorite pizza joint, and you say, I want to buy a pie, right? I want an extra large pie, but I want the cheapest pie you got. It's going to be a cheese pizza, right? That's it. It's a cheese pizza. Well, that's when Fannie Mae and Freddie Mac, when they basically set mortgage interest rates, it starts with a cheese pizza. I mean, we're all getting the same thing, pretty much. Okay, that's why rates don't vary really that much from one lender to another. But if you say, I want it with pepperoni, sausage, black olives, what starts to happen to the price of that pie?
It increases, right.
There you go. So it's kind of the same thing with mortgage rates. The loan level price adjustments are like adding those ingredients to your pizza pie. So as you have a lower credit score, it's like adding that pepperoni. As you have a higher loan to value, it's like adding those black olives, so on and so forth. And the more risk that's allocated on that loan, it's like adding more of those toppings onto your pizza. before you know it, you got a $50 pie.
Yeah, you're starting to lose me here a little bit.
Am I starting to lose you a
Well,
little bit?
only because, so help me understand, if I have great credit, my risk should be very low and I should be able to get a loan at the lowest pizza pie price.
Exactly.
And why are you going to charge me more money for that?
And that's not what happened. And that's exactly why I'm here to kind of give you the truth of the matter.
Okay.
So if you have excellent credit, a good strong down payment, it's like that cheese pizza, right? You're going to get the lowest price for what you want. So here's an example. On the loan level price adjustment, 0 is what we call par. Okay, so no adjustments whatsoever to your pizza,
Right.
okay, or to your interest rate. So on the new loan level price adjustments, if you have a 780 credit score or better, if your loan to value is 75% or less, 0 adjustments. Okay, 0 adjustments. So you get the best price possible, just like getting that, nice cheese pizza without having to pay any more for it. But here's the difference if I had a 680 credit score. Okay, if I had a 75% loan to value, I'd pay 1.125 in additional points or fees. So I've already proved to you that if I have a lower credit score, I've got to pay more for it. Now, what do these fees equate to? Well, about every half a point in fee, Phil, is about 1/8% in rate. Okay, so on average, if you had what I just described to you, which is about 1.125 adjustment or loan level price adjustment, that pepperoni, that sausage,
Yeah.
I'm going to pay about 1/4 to 3/8 higher in rate than the person who had the excellent credit score. So again, that's showing you that a lower credit score borrower is always going to pay a higher interest rate than a high
And what
credit score
what was
borrower.
it before this went into effect? For
So
the same,
here's
for the same credit score.
So here's the old ones. Okay, if I had one of the changes they did is the highest credit score tier used to be 740 or greater. Well, now it's 780 and greater. They've made a few more tiers, okay, which actually is pretty good because there are some improvements for those with the even higher echelon credit scores. Customers all the time would say, Nathan, my credit score is 800. Well, frankly, once it's over 740, it didn't matter. One of the new loan level price adjustments, once it goes over 780, now you're at that top tier. But here's an example. Like before, if I had a 680 credit score, if I put 20% down, it was going to cost them another 1.75 in points, okay? Or about another half a point in rate. If you had a 740 credit score, it was going to cost you a half a point, okay? So even though you had the highest credit score possible under the old loan level price adjustments, with 20% down, you were still paying a premium. You still had to pay for pepperoni even though you didn't want it, So on the new regime, on the new loan level price adjustments, at 75%, again, no, cheese pizza, no adjustments. You go to 80, it's a 3/8 of a point adjustment. So it's actually lower at an 80% loan to value on the new adjustments than it was on the old. So again, even for the highest credit score echelon buyer, it improved at certain levels under this new pricing. Now, where some of the craziness has kind of come out is because some of the lower credit score tiers got a little bit better. Now, is that a bad thing? No, because we're already at a higher, interest rate environment right now. So I'll give you an example. Under the old loan level price adjustments, if you had a 660 credit score and you said, I'm going to put 20% down on a home, that's a decent amount of money,
Sure.
right? It's a decent amount of money. Your loan level price adjustment was 2.75. I mean, that's almost 1% higher in rate than if you had the cheese pizza, no adjustments, right? So on the new, what they did is they said, okay, we don't want to swing so hard at these average credit score buyers, so we're going to adjust those loan level price adjustments down a little bit. Still much, much worse than if you have a great credit score. So under the new, for a 660 credit score, 20% down is 1.875. 1.875 versus 2.75. So it improved almost a whole point for those
Right.
middle credit score buyers. So maybe now they're paying 3/4 of a point higher in rate, but they're still paying a higher rate than you who has a 780 credit score or better. They didn't take anything away from you to do that. They just said, hey, rates are already high enough. we're going to make some adjustments so it can be more affordable for some of those middle credit score borrowers. I mean, that at the end of the day really is what the truth of the matter
Now,
is.
so it is interest rates, it's not fees.
So fees can convert to rate. So in other words, if let's just take for example under the new loan level price adjustments. Let's say you have a 740 credit score and you're going to put 25% down. You have a 3/8 fee because you have a 740 credit score and you have a 20% down. Okay, so that's like adding the pepperoni. Okay, so I can say, I tell you what, I can charge you the 3/8 in fee on a $100,000 loan that's $375 to make the math easy for our friends out there. Okay, or I can say instead of a rate at 6%, we're going to bump that up 1/8%, 6.125, and then you don't have any extra costs involved.
So I could either pay the fee and get the lower rate, correct?
Exactly, yep.
So why would I not pay that 375 versus pay the fee?
Yeah,
over 30 years.
Yeah, well, yeah, on a $300,000 loan, for example, we're talking $25 a month, right? So that might be closer to
over 30 years. That's a lot more than $375.
Yeah. It all depends on a couple factors. How long am I going to keep the mortgage? How long am I going to keep the house? Because sometimes somebody may say, well, I'm going to have only this mortgage for a couple years.
No, I know the
refinance,
mentality behind it, but I mean, in the long run, $25 a month over 30 years. I mean, it only takes a few months to make up $375.
No doubt.
It's a kind of a foolish math problem to stretch that 375 over $25 a month is
Yeah.
what you're telling me.
Yeah.
So,
Yeah.
to the people out there, that's not a good math problem to have, right?
Right.
So the return on the investment is ridiculous. So you would pay that $375 up, or you can pay that interest to me, and I will put up that $375.
Yeah, there you go. There you go.
No,
Phil's bank.
Yeah, I mean that's I'm just saying that's just not a good math problem to have. But no, so understandable. So you're saying that this isn't an interest rate issue, that this is a fee issue first and foremost, that you're charging point fees here, okay, and that the point fees for the less credit worthy are going to be less fees to get a mortgage if they qualify.
Yep.
Than for the better credit worthy will pay more fees up front.
You got that wrong.
Then how is that wrong?
So again, under the new loan level price adjustments, if I have excellent credit,
Well, I don't mean let's say the 780 is out. Anything lower than the new price tier is you're still paying more fees.
you're going to always pay fees
Right.
based on your loan to value.
But they went up. They went up from the old fees. At some point, they went up from the old fees.
Yes.
And I'm saying, so there's, in this new adjustment, some people with excellent credit, right, have gone up, and the majority of people with less credit went down, and it's not affecting interest rates, correct?
Right.
It's affecting fees. So,
Right.
so good credit people, not super great credit people, good credit people are paying more fees than less credit people under this new policy, not interest rates. And that's the big thing that I want to make sure that everybody gets across, is that this is first and foremost a fee issue. Now, you guys can wrap that fee into points that then become part of the, interest rate that they pay over 30 years. Whether that's smart for, the consumer is their choice, right? That's not my choice to make or whatever. They just need to be clarified that is their choice to make on whether they want to roll that into a 30-year note, which they would pay massive amounts of interest on, versus just paying those upfront fees, right?
The only thing I want to just make sure, though, and now we can see why it's gotten so confusing, right? One thing to make really, though, clear is the fees for the higher credit score borrower are still less than the fees for the lower credit score borrower.
That's exactly true, but they did go up.
They did go up.
And they did go up. While, and this is what the the good credit people are complaining about, is that their fees went up and people with less credit worthy or higher risk went down. And they're going, how is it that me with better credit, this is the argument, and this is what I'm hearing. So in the street is what we're hearing. This is what, the people at the top aren't paying attention to or are not allowing to come out into the market. And that's all I'm trying to make a point out, is you got people who have great credit. Don't forget about this over and above elite credit that you're talking about.
Okay, yeah.
So you have this people that had really good credit, okay, that would be considered really good credit. Their price went up, while people who had credit that was considered a risk went down. So we are giving people who are higher risk less. We're giving them, less rate, and we're giving people who have higher credit worthiness, we're raising their rate. And that's why people are saying, why is my rate going up and people below me who are bigger risk getting a lower rate? And their interpretation is you're taking my money and giving it to them.
Yeah.
That's, and you could understand, but that's why you can understand. Now, they were thinking that it was going to the interest rate. And my clarification is that it's not going to the interest rate.
Right.
It is just a fee.
Yeah.
Now,
in many cases, it was as little as 1/8% in fee difference. I mean,
that's fine.
Minute.
That's fine,
Minute.
but I just there's a big clarification of it not being an interest rate issue. It's a fee issue, but the comparison is accurate as I described. Is better credit-worthy people are being charged more fees than less credit-worthy people. You can justify it any way you want, that that's a good thing or a bad thing, but to the people who work very hard for that good credit are being penalized.
Yeah, but
that's how they're thinking about it.
Yeah. And it's not that way at every loan to value, which is the other thing to keep in mind, is even under the new loan level price adjustments, in many cases, even for good credit, it's either the same as it was before.
Right.
In some cases, even better if you've got a large down payment.
Right.
The lower the down payment, the more that what you're saying is correct.
But that reduces the risk to the loaner, right? So that's just showing again that you've got great credit. So you're rewarding the great credit person, but you're taking away the great credit for holding on to their money. So there's this game. Look, the bottom line, folks, is what Nathan's going to do, and we're going to put up on the screen, is we're going to put up the comparisons of the old versus the new. So you'll see the entire line items. And we don't want to make this a big deal. And I'm kind of playing devil's advocate here. I'm not trying to be argumentative, but I really am, because, I've heard many of our customers out there really make this comparison and are pretty upset about it. Now, it's was going into effect on May 1st, and Nathan will tell you that it went into effect way before May 1st, okay? But nobody in the media, nobody in the market actually told anybody, right, that it had to go into effect way before it actually went into effect, because all these guys in the mortgage business had to include it for any deals that they were doing prior to this actually going in. So we didn't even know it as realtors until we started asking the questions. So I wanted to make this podcast happen so that we got real clarity out there, so everybody out there in the marketplace really heard it from the horse's mouth. We know what the real numbers are. We're going to have it plastered up here so that you can see what those comparisons are. Nathan will make a nice chart for us so that you can really see it. He's a really good guy. He knows his stuff. He'll have his information up there. You can give him a call. You can check it out. You can ask any questions you want. This is really for your information so that you know what's going on in the market. So, listen, keep an eye on what we're doing. We're going to have another podcast shortly with Nathan to go over all the stuff that's happening to the marketplace. Like, share, subscribe. Make sure you look at mydigitallisting.com. Nathan, give your information, please.
Yeah, you can reach me at 239-898-8841. You can always catch me on my website, agentslender.com.
Guys, we'll see you soon. Have yourselves a great day.